What is going on, everybody? This is S Trades, and this is day 5 of the bootcamp. And in this video, we're going to be going over liquidity. I kind of hinted it in the previous video of market structure and how trends move. I kept mentioning liquidity sweeps, liquidity that, and this and that, whatever. So, what is liquidity, right? Remember how I told you guys in the previous video that bodies and wicks tell you two different stories, and it's really important to wait and see if the body's closed or if it's just a wick and the wick out and then like a fake move or whatever. So, how does the market move? The market moves in two ways, right? It seeks liquidity, it takes out the liquidity, which is the highs and the lows, right? As you can see, like for example, this is liquidity right here, this is liquidity, right? This low would be liquidity, right? So it seeks out liquidity and it rebalances inefficiencies, right? We're not going to be going over inefficiency because it's a whole different video that needs a lot more time to explain. In this video, we're just going to be going over liquidity. What does it mean to seek liquidity and stuff like that. So right here in this picture, we have a liquidity sweep and a liquidity run, right? So the two differences, right? So we have this high right here. Like, let's say this is a very important high, right? Like a 1 hour or 4 hour high. What a liquidity sweep is pretty much the market makers, right? The ones that move the markets and stuff to the ways that they want for their clients and things like that. So how do they actually move? They're not going to enter a random long over here at the top of the move, right? What are they gonna do? They're gonna bring the price lower to them, like to their investors or whatever, whoever is trading for them or whoever they're trading for. They're gonna bring the price lower to have a better feel, because at the end of the day, the banks, the big institutions and firms, the ones that move the markets, the ones that pretty much have to say where they enter, and they're always at a winning position. Like they're always enter in good positions. They're always long at the bottom. They always enter longs at the bottom, and they're always short at the top. They're never gonna like long at the top and then short at the bottom and then get stopped out, because market makers are the ones that are moving it, right? So in this case, a liquidity sweep, right? What would it be? We have a high right here. Boom, we have a fake candle that breaks out of the zone, right? A lot of the retail traders probably thought we're going to keep on going higher, but what liquidity sweep is going to pretty much make a fake move, and then now the price is going to actually push lower, right? And what liquidity run is pretty much when bodies close above a high, right here we have candles closing above it, and we have continuation. We have candles closing above it and keep on going forward. So that means price is pushing past this liquidity zone. It means it took out this liquidity, right? And now we're going to keep on pushing higher. This is essentially what a very important concept that you have to know, which is buy side liquidity and sell side liquidity. You don't necessarily have to call it that. You can just call it like a low or high, like a swing low or swing high or whatever. So the names don't really matter in this case, but because I trade ICT concepts, right? This is essentially what's the call for ICT, right? So we have buy side liquidity and sell side liquidity, right? What does it essentially mean, right? All it is three pattern formation, three candlestick pattern formation. The colors don't mean anything. It could be like red, green. The colors don't matter, okay? But essentially it is a three candle formation. We have a higher low, then we have the swing low that forms, which is a lower low, right? And then the next candle is above this swing low. For the sell side liquidity, make a lower high, and then we kind of get that little swing high. We push above it, and then the next candle make a lower high, right? So what did this buy side and sell side liquidity show, right? So in this case, in buy side liquidity, right, all it means that in this scenario, right, people will be going longs, right? They would look to buy for like contracts or whatever, and to see price move higher, right? For sell side liquidity, all it is people shorting the market, right? They're shorting like over here, right? They're betting that the market is gonna go lower, right? So in this case, for buy side liquidity, if a trader enters along, like let's say at this closure of the candle, right, where are they going to put their stop loss, right? Where are they going to put their stop loss to where if price moves lower, they're going to automatically get out, right? They're going to put at the swing low, right? The swing low was right here. This is where most retail traders put most of their stop losses at, because that's just how it is, right? Same with the sell side liquidity. If people are betting that the market is going to go down, let's say they enter on this short over here in this position, they're going to put their stop loss where? On this swing high. So this illustration was just to quickly show like if a trader enters a long right here, and if a trader enters a short at the bottom over here, where will they be setting their stop losses at, right? They're going to be always setting up their stop loss at the swing low and the swing high. So that's where the liquidity is linked. This is where most of the stop losses are at. This is where prices probably, like if a liquidity sweep was to happen, price would come lower, take out this low, and then make the real move. And in this case, price would come up higher to the swing high, take out that high, and then make the actual move and go lower. So to make the visualization even more easier, I'm just going to show it on a line chart. So like I said earlier, remember guys, a uptrend, a bullish trend is higher highs, higher lows, right? So in this case, we keep on making higher highs and higher lows, right? And then we're in an uptrend, but sometimes, most of the time actually, the trends aren't going to be always picture perfect like this. We're not just going to be always making higher highs and higher lows. Instead, what we're going to be doing, like I mentioned in the previous video, we're going to be taking out lows. We're going to be sweeping the lows, also known as a liquidity sweep. So how it's going to look like, we're going to make our higher high, higher low, higher high, and then boom, we come out, we take this low, and then we continue on high, right? Same case, we'll go lower a little bit right here, take out this low again, and then continue our actual move up, right? So this is essentially what's called the liquidity sweep, right? So let's say if I enter a long over here, right? I would enter over here and then set my stop loss below the swing low, right? And then continue my move up, right? Same case, if I enter over here, right? Set my stop loss below the swing low. This is just kind of how everyone does it, right? So all of these zones, all of these lows, right, is a very like a magnetic field kind of, or like what price is likely to retract to, right? These lows have a lot of liquidity, have a lot of money resting, right? Just think of liquidity as like cash, or where money is resting, where price is kind of most likely to come out, take out the low, or and then continue to move higher to make the actual move, right? Because the psychology behind it is, if we come over here, right, and if we're not having a picture perfect uptrend like this, higher highs and higher lows, let's say if we're making a higher high, higher low, higher high, and then the next low is a lower high, right? We come out below this low, right? A lot of people are going to be starting to panic, and then they're going to start shorting, and they're going to start selling, thinking that, okay, now we're going to go lower. We're not going to be actually in an uptrend. So what the market makers are doing, they're pretty much, it's not that they're necessarily taking out retail traders, because they have so much money. It's not that they're like hunting retail traders. No. A quick disclaimer, I don't fully agree with everything that ICT says. I just follow some of his concepts that are kind of proven for me to work. I don't agree with a lot of the things that he says, especially in this case. Like, I don't necessarily think that market makers are over here targeting retail traders because they have so much more money. All that they're doing is they're getting a better fill, right? Some of us could, let's say, enter a long over here, set our stop loss over here, and then hope the price goes up. Market makers, the big firms, the big institutions, aren't going to be entering longs at the top of the move, right? What are they going to do? They're going to push the price lower so they can get a better fill, right? So in this case, after sweeping this low, also known as liquidity sweep, then they would enter a low, they would enter a long to then target whatever they're targeting, right? So then they have a lot of way better fill than if we were to have the long up in here, right? So this is just kind of how market moves on a daily basis. It always takes out the lows, it always takes out the highs, just to get better fills for the market makers. So you have to pay attention to that. The same exact scenario for shorts or for bearish moves, right? So this is how you would see a perfect play for a bearish trend, right? Lower lows, lower highs, lower lows, lower highs. So we're not going to actually always see this perfect trend. What we're going to see is lower lows, lower highs, and then come up, sweep out the high, and then push lower, right? Come up again, sweep out the high, and push lower. So again, all of these highs is where liquidity is at, right? This is where the money is at. This is where the market makers are probably going to push their price up to take out these zones and to get a better fill for their entries, right? So a retail trader would enter a short over here, right? Let's say I'll enter a short over here, sets a stop loss above the swing high, targeting lower, and what happens? The price ends up coming and taking out this high and then making the actual move lower. And I bet a lot of the people that trade this, you guys experience this multiple times, where you enter a trade, it comes like a point below your stop loss, it takes out that stop loss, and then it just shoots up automatically to your TP. And just for a better visualization on the actual chart, right? Just a quick practice on what swing lows and swing highs look like, right? It's pretty much the lows and the highs, right? So how does it look like? We have to have a 3 candlestick formation. Doesn't matter what color it is, right? Just have a higher low, and then a swing low, and then another higher low. It's a 3 candlestick per formation. So in this case, what do we have here? We have a high low over here, right? This wick right here. Then we have the swing low, right? The next candle is a high low, right? So this is what? This is buy side liquidity, right? Another example is we have a high low over here, then we make a swing low, and then we make another high low, okay? Again, buy side liquidity, right? What do we have here? Buy side liquidity again. Why? Because we have a higher low, swing low, higher low. And let me show you some bearish examples, right? So over here, good example, right? So we have a sell side liquidity on this area, because why? We have a lower high on this wick over here, then we make a swing high, and then the next is lower high, right? Think of it as a little curve, right? So we have another, what do we have here? We have a higher low, make a swing low where we push past it, and we have another higher low, right? Again, what is this? Buy side liquidity. This is another good example, right? what in this case, which one is the sell side liquidity, right? It's not this over here, right? It's not this zone over here. Instead, it's this over here. Why? Because we have this 3 candlestick pattern formation. Here we have our lower high. We push past it, we make our swing high, and then the next candle again is lower high. So this is sell side liquidity. So this is sell side liquidity. Where is this? This is buy side. What is this? This is sell side. So these are all lows and highs. You could say just swing lows and swing highs. You don't need to mark out every low and high. But now some real chart examples, right? Look at this. So you have to see all these like obvious swing highs and swing lows, right? So what in this case, let's say we have this high, this low, right? This high, right? And then we have another low right here, right? The ones that just like stick out and you can just easily see, right? What happens here, right? We make this bullish move, right? Making our high highs and high lows. So people are thinking that we're going to be continuing our uptrend, right? So then what happens? Price starts to retrace over here, right? Coming all the way down to this low, right? What is this? This is our buy side liquidity over here because we have this 3 candlestick pattern formation, right? What happens here, right? I have to even zoom out for you guys to see, zoom in so you guys can see it. Price literally takes out this low by a tiny, it's not even a wick, like it's less than a tick. It ends up taking out this low, and then what happens? Price ends up just skyrocketing higher, right? And this constantly keeps on happening. What do we have here? We have our swing low. Price comes, takes that low, goes up higher, right? What do we have here? We have our buy side. Price comes, takes out this high, and then it kind of plays around in this area. We have another high right here that ends up forming, right? What happens again? We end up coming up, taking that high as well, and then we have price push lower. Then what happens? We take out the swing low, our buy side liquidity, and then price ends up pushing high, right? So now in this case, this was the obvious high, right? This right here was a liquidity run. This wasn't a liquidity sweep because why? All these candles ended up closing and price ended up pushing past it, right? See how price ended up closing above this high, ended up pushing higher. We didn't have any of these long wicks like here over here, right? See the swing low, we had a wick come below it and then push up higher. We didn't have, like, for example, this high wick all the way up over here, taking out this high and coming lower. Same again here, wick came all the way on the top, took out this low, took out this high, and then we ended up going lower. We didn't have that here. What we had instead, the candles ended up closing, and we saw a follow through. We saw displacement, right? Displacement is pretty much all the powerful move, the moves that are happening with momentum. All these candles, big bodies, end up going above this high. So the way the psychology behind liquidity is for retail traders, right? Let's start from the beginning, right? So let's say over here, right? We were still in our bearish trend, right? We came up. This was our most previous higher high, our swing high, sell side liquidity. We ended up doing what? We ended up coming on top, taking out this high, and then pushing lower, right? And then what happened? We ended up coming over to this low, taking out what? This buy side liquidity. We took out the zone, and then we kept on pushing higher. So how does that, like, what does that even mean, right? So as a retail trader, right here, you saw there's like one candle ended up closing, right? You see this body ended up closing above this wick. So people are like, okay, now we're going up. We closed above it. Let me set like my stop loss at this previous swing low, right? And I'm targeting whatever. Let's say I'm just targeting this zone, right? So what happens then? This is how some of the retail traders trade. They trade breakouts, right? I have nothing against breakout traders. For me, it just doesn't work. I tried it before, but for some it works, right? But the psychology behind it, some retail traders would enter along over here thinking that, okay, just because one candle closed above this high, that means we just have to guarantee to go up right now. What happens then? We ended up coming lower and doing what? Taking out my stop over here if I would have set it and going all the way over here. Now let's say if we lost this trade and price ended up coming all the way lower over here, so then we're like, okay, well now zooming out on the picture, we are in a bearish trend because we keep on making lower lows and lower highs. And if, let's say, if you do no liquidity sweeps, you'd be like, okay, we swept this high, now we're guaranteed to go lower, right? And let's say if you moved, if you waited and you missed out on like whatever entries that you might have had here, and let's say you enter on a breakout over here, right? Say, boom, our candle ended up closing below our previous low, right? You see this little candle body that ended up closing, right? And let's say traders started entering shorts now, right? Because what we entered long over here, we got stopped out, and then we got proven wrong. So now you're like, all right, we're gonna go lower. So now let me enter a short instead. So now let's say you enter a short right here on this breakout, put your stop over here, and then what happens? We get another liquidity sweep, right? We come, take out this low, and then do what? Push up higher, right? So this is essentially what liquidity sweeps are, and pretty much it's one to get a better fill, right? A market maker or a big firm or a bank institution is not going to enter long at this top move, right? What they're going to do is they're going to push the price a little lower to get the best fill possible, right? Because banks always win, they never lose. So in this case, they're not pushing all the way lower, getting there long, probably all the way down over here, and then this is like freaking optimal entry, you know what I'm saying? And this happens on every single time frame, right? So this is a daily, like this is price action worth of a whole year, right? And this constantly keeps on happening. So we had two liquidity sweeps at the same time, right? This was our most recent swing high. We ended up coming over here, taking out this high, pushing price lower. So people are like, okay, we took out this level, right? Our sell side liquidity, and now we're gonna push up lower because we sweeped it. Now we're guaranteed. So let's enter shorts over here, right? Then what happens is price comes again and sweeps out this zone again. This high got swept again, and now we made the actual move. See how after every liquidity sweep, price just ends up like skyrocketing up or just dumping so fast, because now the big banks and the big firms and the market makers have entered the trade, because since they have the large amounts of money and they're the ones that are moving the markets, not retail traders. So after you see these sweeps and then you wonder why market moves so fast, is because now the big guys, the big ones in this industry have entered the trade, right? And that because they're the ones that are moving. We have absolutely no effect unless you have like millions in your broker and you're trading with that amount. What we would have here, this is our most recent buy side liquidity, right? We have our swing low. What happens? Price comes below it, takes it out, goes higher, right? And this was the most recent example that we just had. This was like where people were panicking that we're going to be going into a recession, right? This was just a simple correction. Like this is literally just for a bank or for whatever institution that was pushing this move, just to get a better feel for their longs, right? As you guys see, this is a weekly. This is almost 2 years worth of price action, right? What are we doing? As our previous video showed, we are in an uptrend, right? We keep on going up, So this even has all the retail strategies proven wrong, because if you're trading trend line, let's say, right, you have this trend line drew. I know I didn't probably not draw it right, but let's say you draw this trend line and you're like, okay, every time price comes into this trend line, we keep on respecting it, right? So then what happens here? We have this very, like I said, you have to have these very important like swing highs and swing lows that could just stand out to you, right? What, like, if I just zoom out, which ones stand out to you? The ones that stand out is probably the ones that are very important, right? This one right here, this one right here, right? This one right here, right? All of these very important swing lows and swing highs, right? So in this case, people were panicking, people were thinking that we're going into a recession now, right? What happened here? We came all the way below over here, made like almost we made almost a 4,000 point move. People were thinking that we're going into a recession. That's it, everything's going down. This trend line broke. People are now entering shorts because why? The trend line broke, and now we're gonna be pushing up lower. What happens? We push all the way down here. Look at this wick. Look how massive this wick is, and this is a weekly wick. So this is very powerful. That price ended up coming all the way down here, taking out this very important low, and then price ended up closing like this. We're most likely gonna go high, right? So now if you're looking at a daily, same thing, right? Very important low, ended up doing what? Coming and taking this out, and now price ended up pushing up higher, right? So this just constantly keeps on happening, right? Over here again, some more examples for you guys. There's a very important, very obvious swing high, right? What happens? We come, take out this high, push lower. This is our previous swing low. Again, very obvious. You can just see it. What happens? We come, we take this level out, we push high, right? Now, how does a liquidity run looks like, right? Liquidity run is every time when price just runs past this liquidity, past these lows and these highs with a lot of displacement, right? So in this case, right, what is all of this? This is all liquidity, right? All of these highs, all of this is liquidity. This is where all the money is resting. This is where price is probably gonna go to, right? All of these important highs, right? they act like, pretend like these highs and these lows are just like magnets. Price is just always magnetic towards them because it's a very obvious pool of liquidity. This is where cash is, where all the money is resting at, all of these highs, right? So how does a liquidity run look like? You see all these lines that I drew, these are very all important liquidity. So every single one of these highs got ran through. You see how all these candles ended up closing above it? We have lots of displacement. This was a liquidity run, right? All of these highs end up closing above it. All the big bodies, see how much bodies ended up closing over here? 1, 2, 3, 4. Now this is displacement. This is a liquidity run. Again, what do we have here? Another very important high. What happens? A big massive candle ends up closing above this high. Then it's most likely a liquidity run, and it's not a liquidity sweep, right? Again, this keeps on happening, right? What happens? We push up above this high, close above it. Now right here, what happens? We have this low that we made, right? Came down, swept it, pushed up higher. Same thing over here. Our most previous low right here, what happened? We came out, took it out this low, pushed up higher. And then what happened here? This is a very important low, right? Very important high. Very obvious, it just sticks out to you. What happened here? We came out, took this high. People are probably so confident in this bullish trend. They're like, oh, well, we took out this high. We're most likely going to push up higher. What happens? We just dump, right? So it's very important to see and wait until the candle ends up closing rather than pre-firing or entering trades early and then getting stopped out. And then what was this move essentially right here, right? This is just literally to get another better fill, right? All of this liquidity over here that was getting built up. What happened? Price just swept a very important high and then dumped. Took out all this liquidity to do what? To now make the actual move higher. Boom, we made this actual move higher, pushing past all these important highs. You see how much displacement was pushed through all of these? Boom, all this displacement up. And then what happened? Price ended up coming all the way lower again, sweeping out this very important low to do what? To push up higher again. And this is literally keeps on happening constantly, day in, day out. Like I said, time is fractal. All this stuff that I teach, it all happens across every single time frame, going from second charts all the way to hourly charts, all the way to like 5-minute, 10-minute, daily, weekly, monthly. It happens on every single time frame because time is fractal. And liquidity is one of the most key aspects in ICT concepts and in general, like smart money concept fields and whatever strategy you might be using. Liquidity is essentially like everything. Like this is where everything, all the strategies start from liquidity. This is like a very important thing to learn. So if you guys didn't understand anything, rewind the video back or comment in the description. I'll be going over and seeing if you guys need any help with that. But essentially think as liquidity as the highs and the lows that are very obvious, that are like just popping out to you, that you guys just like tell. If you just zoom out, okay, I see this is a higher high, this is a lower low, right? This is a swing high, swing low. This is a sell side liquidity, buy side liquidity. These words are all interchangeable. You don't need to call it exactly a buy side liquidity and sell side liquidity. Just say like swing high, swing low, swing high, swing low, or like just just a regular high and high, just a low. So the names, don't focus too much on the names, but just very obvious liquidity pools act as magnets. This is where you're taking your profits. This is where you're setting your stop losses at. So essentially, liquidity is very important. So yeah, guys, this is it for this video. This was day 5, and I kind of went over liquidity sweeps, liquidity runs. Again, this is a very important concept. Make sure that you guys understand this. Very important. Like this is very important. One of the most important things that you guys could need to understand. And yeah, I'll see you guys in the next video.